Ladies and gentlemen, Christopher Aaron here. Thank you for tuning in. It is the 21st of February 2018, and we continue to live through an absolutely fascinating period of time to be alive. We are talking about the continuation of the bubble in confidence in this institution of central banking, this institution which is geared toward helping member banks primarily, and secondarily, keeping the economy running. But let us not ever put the cart before the horse. Central banks exist to divert wealth from the broad economy to their member banks. Yet this is a bubble that we are living in at this time, when the Fed is actually having so much control over the market that the sum of the market, is hanging up on every single word that is uttered out of this consortium's collective mouth. And so we see instances like today where gold is about to break out of a declining trend that we've seen over the last week, and the Fed releases a statement today, the minutes from the last meeting, which indicated that it may be hiking rates again coming up this year 3 more times, which is basically what we have already expected, but apparently some members were not expecting this, and they chose to sell gold on the occasion of rising interest rates in the future. We could see the price movement was even more dramatic in silver. Silver getting ready to break out here to re-challenge $17, and boom, the words of rising interest rates sending silver back down to mostly flat for the day. Now, there is some slight outperformance that we're going to look at in the ratio of gold to silver. You can see that today, silver still finished a few cents higher in the day and gold finished lower. There's this slight outperformance that we're seeing. We'll look at that in just a moment. But getting back to this, what was the cause of this sell-off today in the precious metals? And this was a sell-off across a lot of markets, don't get me wrong. But we see this dramatically here in the precious metals. It was the Fed minutes. Once again, the bubble in confidence in these central planners continues. Stronger outlook increases the chance for more rate hikes. How many times are we going to go through this? The minutes of January 30th and 31st, the FOMC, the Fed, released minutes which showed officials that they saw a stronger economy at the end of 2017 and that more rate hikes were in the pipeline. More rate hikes coming. And therefore gold and silver were sold. This market has gotten this wrong so many times, it's starting to boggle my mind how these traders have gotten this wrong so many times. Let's just look at this. So the precious metals were sold off on the chance for more rate hikes. Here are all the rate hikes of the last 10 years. And here is the corresponding price action for gold. Now, I don't know how many months and years traders are going to need to see gold rising amidst rising interest rates to finally get it that rising rates are not negative for gold. But we still see over the short run that the market believes this common myth that rising rates are in fact negative for gold. So because many traders keep getting it wrong in the futures market, I just want to say this once again. Rising rates are not negative for gold. One more time. They are not negative for gold. We can see that very clearly. But the thing is that one of my basic philosophies is that it's not so much what do we know to be true. Yeah, we can know that rising rates are not negative for gold. However, we must pay attention to what the market is actually doing. The analogy is, what if we know that there is no fear. Yet we see a stampede of people coming at us. Do we choose to stand in the road and say, no, there's no reason for the stampede to be coming at me. There's nothing to fear. They were spooked by a false boogeyman. And do we let them trample over us? No. We have to respect, even if they're wrong fundamentally, we have to respect what a stampede, what a herd mentality may do. So that's what we're seeing here in the precious metals. We're seeing this herd mentality, this respect in the Fed bubble. It continues. So we have to pay attention to this so that we don't get hurt along the way. That's my philosophy. It's a balance between knowing the fundamentals, yet also respecting the market in and of itself. Let's look at this. So we talked about how silver held up a little bit better today than gold, just minorly, but sometimes a few days of minor holding up better begins the start of a new trend. So let's just take a look at this on the chart. So what are we talking about? The gold to silver ratio. We're looking from the end of 2010 through the present. What is this gold to silver ratio? We are looking, if you're new, and I know this is a rewind for a lot of people there, but if you're new to studying the precious metals, we are looking at a ratio. It is the number of ounces of silver required to purchase 1 ounce of gold. Fluctuates throughout time. Why is this important? Because a falling ratio, moving lower, tends to correspond with rising precious metals prices. Let's look at some examples. The 2011 top in silver, right at $50, corresponding with this peak right here, this bottom in the gold to silver ratio, right at this 30, just near this 30 level. So a low in the gold to silver ratio corresponding with a top in the metals prices. Let's look at another example here. Up here, right before the metals began to take off, we're talking about the 2015 bottoms in gold at 1045 and silver at 1385. We were talking about this happening right here, right almost at the top of the gold to silver ratio for this entire cycle. So we can see tops in the ratio corresponding with good buying times. One more little example here. Let's look. The 2016 tops. Gold 1378, silver 2125, corresponding with this bottom right here. Now, what's another important thing that we can see? As you know, I'm big on a strict study of parallel channels, or channels, converging channels for that matter. Markets tend to move in trends until those trends break. And the breaking of these trends, what we see right here with the magenta arrow, breaking of trends tend to represent important turning points in the markets. So think about this. When was this? April of 2016 that this channel broke lower in favor of silver. What did this correspond with? This was the strongest surges that we saw in 2016 in both metals. So a breakdown corresponding with strong rises in the metals. Now, what's so important that's happening here? We talked about this in looking at the short-term chart. What's so important that we're seeing on a short-term basis, right? So this channel broke down. We're going to zoom into this box. It broke down. It's come back up. It's testing the upper regions of the same vicinity here, slightly above 80 ounces of silver required to purchase 1 ounce of gold. Let's zoom into this. Why is this so important? Remember where we are in the big picture. We're retesting this channel. Zoom it in. What do we see here? We're now looking from late 2015 through the present, extended. What is this pattern that we see here? This terminal rising wedge. Now, this is a bit technical to get into, but you can see the shape of this wedge, right? These converging lines here forming the shape of a wedge, almost like a wedge of cheese or something like that. And why are these wedges important? Because they tend to represent terminal movements of a trend. So in this case, we're talking about a terminal wedge that represents the rising retest of the gold to silver ratio. And this is getting, we're talking about a whole lot of things happening here at once. A rising, meaning falling metals prices. We've seen that since the peak in 2016. A rising wedge, yet this is terminal in nature. So this market is getting ready to break this wedge. This is what wedges, especially when we look at this multi-year time frame, tend to represent. When is another example of this? Let's flip back in memory. And by the way, I was making videos at this time. You can go back to the videos in January of 2016, February of 2016. We're talking about silver. This is silver. And we were looking at a terminal bottoming wedge, this giant wedge that formed from 2013 through the beginning of 2016. And I was saying at that time, guys, we can't predict the exact date. These wedges tend to run about 2/3 of the way through, and then they break. Anywhere from 2/3 to 3/4. They tend to not reach the very end. And so I was saying, guys, all things considered here, below $14 an ounce, we're entering the final stages of this terminal wedge. And people had to see it happen in real time. We saw that initial breakout and the retest, and then what happened. Of course, silver advanced up to 21.25 through early July. This was a major breakout. I mean, incredible moves that happened in silver, gold, and especially the silver mining companies. A lot of companies rising 300-400% from the low to the peak. So the point is here, these wedges. Pay attention to these wedge patterns. If you like to study technical analysis, not every bottom, but many bottoms form wedges on some time scale before the break. And there's often a retest. There's a backing and filling process that has to happen. But this is showing you that this pattern is getting ready to change. Anyway, bring it back to the gold to silver ratio. We're seeing once again the opposite of that, a terminal rising wedge. So I can't tell you exactly when this is going to break. But if we start the wedge down here in early 2017 and we look at when it must conclude the apex here in October, November of this year, and I told you these wedges tend to break usually 2/3 to 3/4 of the way through. We're getting pretty close. This is going to coincide with a breakdown in the ratio, which is going to correspond with another strong surge in both metals, but most likely silver to outperform gold, which will be a nice change because we've seen silver underperforming, right, for the last year and a half. This is a terminal rising wedge. You may want to study these patterns if you're interested in this type of technical analysis to the future. Very, very useful to help to spot potential tops or bottoms in markets. So I think we'll have something like a breaking of the wedge, a test of the lower trend line, and I think we're going to see something like what formed here, which is a major move down in the ratio. I mean, this ratio moved from 84 down to 64 within 6 months. There's nothing saying here that we can't move from 81 down to 61 6 months after this breaks. It's getting close. It won't leave a whole lot of wiggle room. It's tough to imagine when we're in the grind, which we still are. We're in the grind right now. It's very difficult to imagine that this kind of a thing could happen. But that's what the charts are showing as we see this irrational sell-off in the metals on the possibility of a rate hike. We looked at the examples. Every rate hike over the last 2.5 years has been positive for precious metals. Yet, every time it's mentioned, traders sell it initially. But these traders are getting it wrong every time, and they're getting spanked. At some point, these futures traders are going to wisen up, and on the hints of a rate hike, they're going to start buying gold. We're not at that point yet. We're simply not there. So we have to pay attention to what the herd, what the mob, what the market, what the sum is doing. We have to do that, or else we will get trampled. We have to pay attention to it. How do we do that? We do that through a study of the charts, through a strict analysis of the charts, what the market is actually doing day in, day out, week in, week out. I gave you an example today in the gold to silver ratio. We're getting close to a significant top forming in that ratio with that wedge, and then things will be moving lower in the ratio. This weekend, coming up in the premium research service that comes out every week and has a special monthly update. Number of requests to this, but this is going to be in the premium service only. We're going to look at gold as priced in the British pound, the Australian dollar, the Canadian dollar, the euro, and a few new ones, the Japanese yen and also the Chinese yuan. There are benefits to examining the patterns that are showing up in every currency because a strong precious metals market should coincide with rises across all currencies. It shouldn't just be a US dollar only phenomenon. Every central bank is engaged in this same policy. There's a worldwide bubble in belief in the central planners, and this is going to pop. It's going to be an absolutely incredible time to be alive as we see, I believe this will happen in our lifetimes, as we see the irrational belief in these central banks fail. This is going to happen while we are alive. That is my prediction. That analysis of gold as priced in all these major foreign currencies will be the feature of this coming premium subscriber video. If you have a unique situation that you would like to speak one-on-one, I do work with individuals, I do consultations, and we speak on phone or on Skype or by email. If you have a unique situation that you would like an independent perspective on, just know that I do not take any funds or money from any of these companies or any of the funds that I profile here. I am simply dedicated to assisting individuals in the best manner that I'm capable of. So I do thank you for tuning in. Let's watch this terminal wedge that is shaping up in the gold to silver ratio as the irrational selling of the metals continues every time a rate hike is announced. This is going to be ending soon.